Well, Scott, I've been talking about the fact that the seasonals are really good. A commentary I wrote on October the 6th basically, encourage people to stop market timing and get invested because from a value standpoint, everything is basically looking cheap. And we're in a time of the year where we should expect to see upside surprises. And, it's no surprise that inflation is slowing. The forward numbers have shown us they're slowing. So, given the valuations have been so strong, I was expecting we should get a bear market rally. And maybe yesterday it was a big deal to say I thought we'd get to 4,100 on the S&P. Today it looks like, we're almost there. So I do think we're going to continue to rally into the beginning of the year. And then, we'll get a chance to take a fresh look at things.
Wow. So, does that suggest that you've come off your view that stocks have a 20% drawdown from here? I believe one that you articulated as recently as a couple nights ago during our election night special.
Well, I think I think the bear market is still solidly intact. I see this as, a relief rally. I always have to fight myself, Scott. My career on Wall Street was I was a trader. Now, I tell people I'm an investor. And so, when you see, the condition that we were in just a month ago or so, it was pretty obvious to me that being underinvested was not a good idea. So I'm still of the opinion, look, I always say I like for the data to talk to me rather than for me to try to, to predict the data. But so far, I would just ride the seasonals here. Things are still, fairly well valued, and inflation is coming down. And I think we are prone to more downside surprises on inflation, which would be good for the bond market. And so, I would stay fully invested at this point, as I encouraged people a month or so ago to do. And, just let the data tell us if this is the bear market will continue, or, are things really at a turning point.
Have you increased your exposure to stocks recently then?
Yes, we have. And we especially increased our exposure to high yield and to longer dated credit investment grade securities. And if you look at the ETFs today, like HYG and LQD, they had a phenomenally good day, much better than Treasuries did. And, Treasuries had a phenomenally good day. So, we continue to be overweight credit. We continue, we're going to hold our existing positions. One of our largest positions, Scott, is in, S5 Home, the home builders, which had a phenomenal day. So, one of the things I'll say, though, is, I do tend to be early. I tend to be early to sell, and I tend to be early to buy. But, I'm also aware of all the research that shows that investors miss the best days in the market because they're trying to market time. And, there are lots of studies that show that if you look at the S&P 500 and you haven't been invested, that a lot of the return occurs in a very few number of the days, and you're likely to miss them if you try to time the market rather than just look at values.